Would you like to own a stake in one of the highest quality companies in the world? You see all of those cars around you? Those cars have to be constantly repaired and maintained. Would you like to profit from that? Earn money every time a replacement part is sold? And collect market-smashing passive dividend income? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
I want to tell you about a high-quality dividend growth stock that pays big, reliable, growing dividends. These growing dividends are funded by growing profit because this business is selling essential products to millions of people every single day. In fact, even during this pandemic, these businesses have been deemed essential and allowed to continue operating. That's how important these products are. I've personally invested in stocks like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across with shares in Genuine Parts Company, which appear to be trading at a significant discount today. Genuine Parts Company, stock ticker GPC, is a major American wholesale distributor of automotive replacement parts, industrial supplies, and office products. Founded in 1928 and headquartered in Atlanta, Georgia, Genuine Parts Company now employs over 50,000 people and has more than 3,100 operations across the world. Their revenue breaks down across the following three segments: automotive, 57% of fiscal year 2019 sales, industrial, 34%, and business products, 9%. Approximately 74% of revenue comes from the United States. Major brands include Napa, Motion Industries, and SB Richards Co. Just look around at all of those cars. Millions of people driving around to and fro. Those cars break down frequently. I'd know. I'd worked in the auto industry for almost a decade. Believe me, repairs can be expensive, yet they're often extremely necessary. That's where a company like Genuine Parts Company comes in. They provide a number of parts that people need for their daily transportation. Plus, they have other impressive businesses that provide necessary everyday products and supplies to office and industrial customers. Now, Genuine Parts Company will certainly not end up unscathed by the pandemic, but they are still operating. They've been deemed an essential business. That's comforting. We can take additional comfort in knowing that they've faced numerous large-scale challenges over the last century, yet they've continued to pay out a growing dividend straight through much of that time frame. Indeed, Genuine Parts Company has increased its dividend for 64 consecutive years. Just think of all that's occurred over that period. Wars, recessions, bear markets, massive inflation, political upheaval, rapid changes in technology. This company kept out pumping bigger dividends straight through all of it. That speaks volumes. And it's not like these dividend raises are small either. The 10-year dividend growth rate is 6.6%. That growth is coming on top of a very attractive yield of 4.35%, which is about twice as high as what the broader market offers right now. This yield is also 145 basis points higher than the stock's own 5-year average yield. Meanwhile, the dividend is protected by a payout ratio of 55.5% of adjusted trailing 12-month earnings per share. I'm using adjusted earnings per share in this case because Q4 2019 was majorly impacted by restructuring. That quarter is not reflective of the company's true earnings power. Admittedly, this payout ratio can, and most likely will, temporarily climb higher due to the reduced earnings from the pandemic-related economic fallout. But as I noted, they're still operating and situated much better than a lot of other businesses. Looking at business growth, Genuine Parts Company grew its revenue from $11.208 billion in fiscal year 2010 to $19.392 billion in fiscal year 2019. That's a compound annual growth rate of 6.28%, which is really strong. I usually like to see a mid-single-digit top-line growth rate from a mature company. They blew right past this, although it's notable that there were a number of acquisitions and divestitures over the last decade that clouds results. Earnings per share expanded from $3 to $5.69 adjusted over this period, which is a compound annual growth rate of 7.37%. A pretty similar result to revenue growth, albeit slightly supercharged by some minor share repurchases. Looking forward, CFRA, a professional equity analysis service, was forecasting a 3% compound annual growth rate for Genuine Genuine Parts Company's earnings per share over the next 3 years. The forecast was provided on March 16th. That's after the pandemic's efforts became apparent. This is more than a 50% haircut in anticipated growth relative to what Genuine Parts Company has done over the last decade. I think that's fair, if conservative. However, on May 6th, after Q1 fiscal year 2020 results, they pulled that forecast and currently have no growth forecast at all. The very near term could be really ugly. I have no doubt about that. It's just so uncertain right now for all business. However, when you start to think about where this company and the broader economy might be in 2022 or so, there's very much to be optimistic about in terms of a return to normal and pent-up demand. Moving over to the balance sheet, the company has long held a fortress balance sheet with few rivals. That financial strength has taken a hit in recent years, most notably after the acquisition of London-based Alliance Automotive Group for $2 billion in 2017. This move gave Genuine Parts Company a major foothold in Europe. AAG was the second largest parts distributor in Europe. It did come at the expense of some balance sheet flexibility though. The long-term debt-to-equity ratio is 0.76, while the interest coverage ratio is just over 9.5. We're still looking at a rock-solid balance sheet. It's just not as incredible as it once was. Profitability is good, especially considering that the core of the business operates basically as a retailer. Over the last 5 years, the company has averaged annual net margin of 4.08% and annual return on equity of 20.66%. Of course, there are risks to consider. Competition, regulation, and litigation are omnipresent risks in every industry. The company is exposed to recessions, although they're somewhat protected from major drops in profit. Any progress in self-driving cars is a threat, as more efficient driving patterns reduce miles driven and wear and tear. The company's largest issue right now is the partial shutdown and the mass reduction in driving, which further reduces wear and tear on vehicles and the need for replacement components. But I see this as a temporary issue rather than a large-scale threat to the business model. This stock has been and looks set to remain a great long-term investment. Better yet, the stock looks undervalued after the recent massive correction. The stock is trading hands for a price-to-earnings ratio of 13.49. That's based on adjusted TTM EPS, factoring out the big Q4 fiscal year 2019 hit. This is obviously well below the broader market's valuation. It's also materially lower than the stock's own 5-year average PE ratio of 20.1. If we strip away the adjustments and look at straight cash flow, we still see a valuation disconnect. The price to cash flow ratio is currently at 11.9, which is way off of the stock's 3-year average P to CF ratio of 15.3. And the stock's yield, as I noted earlier, is significantly higher than its recent historical average. I valued shares using a dividend discount model analysis. I factored in a 9% discount rate due to the elevated yield and a long-term dividend growth rate of 5.5%. This dividend growth rate is about 100 basis points lower than the long-term dividend growth rate that Genuine Parts Company has produced. It's almost 200 basis points lower than the company's 10-year earnings per share compound annual growth rate. I'm clearly being conservative here, but I think this environment warrants caution. In my view, Genuine Parts Company's dividend will likely grow much slower than the historical norm over the next year or so. But I also believe they'll bounce back within the next few years. This dividend discount model analysis is not designed to have you expect 5.5% dividend raises uniformly from here on out. Rather, I think this is a reasonable long-term expectation on average. The dividend discount model analysis gives me a fair value of $95.25. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. We can compare that to where professional equity analysts are at with this stock. Morningstar rates Genuine Parts Company is a 4-star stock with a fair value estimate of $90. CFRA rates Genuine Parts Company as a 4-star buy with a 12-month target price of $90. We have a pretty tight consensus here. Averaging the 3 numbers out gives us a final valuation of $91.75, which would indicate the stock is possibly 26% undervalued. Here's the bottom line, guys. Genuine Parts Company is a high-quality company with essential businesses in a very uncertain environment. With more than 60 consecutive years of dividend raises, a market-smashing 4% plus yield, a sacrosanct dividend, and the potential that shares are under 26% undervalued, this might be your chance to finally buy this amazing dividend growth stock on sale. I hope you enjoyed today's video. Give us a like if you did. Please subscribe to the channel so that you're notified of new content when it comes out. Also check the description box below for some important links and additional information. I'll see you next time.